If you're thinking about investing in AI data centers, it's understandable why. So this article from the Wall Street Journal pretty much sums it up. It says, why the AI industry's thirst for new data centers can't be satisfied. Well, first problem with that headline is that AI isn't an industry classification. It's very difficult to classify, and these days everything's an AI stock, so you need to be rather careful. But you see they talk here about a shortage of the parts, property, and power needed to build sprawling warehouses of supercomputers. So that's what they're referring to when they talk about data centers. You see some interesting statements here, how the lead time to get custom cooling systems is 5 times longer than a few years ago. Delivery times for backup generators have gone from a month to as long as 2 years. So there's a big push to build out data centers, and this piece from CB Insights talks about it as well, how Alphabet, Microsoft, and Meta spent a combined $32 billion on CapEx in the first quarter alone for servers, data centers, other infrastructure. You see the mentions in earnings calls there. So everything is about building out data centers, and Cisco on this slide shows us there are different types of data centers. So you have co-location data centers where everybody's stuff is mingled together, managed services. Enterprise data centers probably describes this build out best, going back to that comment about warehouses of supercomputers. So this diagram by Vertiv spells out the sort of equipment that goes into building out a data center. Interestingly enough, you see the thermal management components. Cooling accounts for some 40% of a data center's energy consumption. That's very interesting, right? That's from McKinsey. So if you can sort out the cooling problem, that would be a good thing to do. And the scale at which they're building out these data centers is rather remarkable. One example being Microsoft and OpenAI. They plan to spend up to $100 billion on an AI data center that will include a supercomputer called Stargate, which is set to launch in 2028. The Reuters piece goes on to say there's skyrocketing demand for AI data centers, and this statement here is telling, capable of handling more advanced tasks than traditional data centers. Going back to that point about how not all data centers are equal. So this new one being built by Microsoft and OpenAI is going to be 100 times more costly than some of the biggest existing data centers, and it says a significant portion of the cost of the remaining phases involves acquiring needed AI chips, going back to the AI chip thesis. We'll touch on that in a second. But this makes one wonder how you might get exposure to the growth of AI data centers, and we found 2 ETFs that claim to offer such exposure. One from Mirai. They're a financial group with $550 billion in AUM. And then you have iShares, the BlackRock franchise. They're managing $3.3 trillion in AUM. So when firms like this talk about having an ETF or produce an ETF that describes a particular theme, it's worth paying attention to what their experts think you ought to have exposure to. Now, as we've learned in the past, it comes down to the indices that these ETFs run on. First question we want to ask here, what are the common stocks found between these 2 ETFs? So the GlobalX ETF has 25 stocks, iShares ETF has 28. What did they choose in common? All right, the top 4 stocks for each ETF are the same, and the ranking may change, but they're the same 4 stocks that both ETFs chose. 2 data center REITs, Equinix and Digital Realty. So these we've covered in a previous piece on investing in data center REITs, and you can watch that. These aren't something that we'd want exposure to. Then there are 2 cell tower REITs, Crown Castle and American Tower. Interestingly enough, cell tower REITs are said to be the largest REIT sector by market cap. They own about 50 to 80% of the 100,000 to 150,000 investment-grade macro cell towers in the U.S., and these towers host broadcast equipment from companies like AT&T, Verizon, T-Mobile, and such. So on the topic of REITs, these are an asset class that's highly diversified across various types of exposure. We gave you 2 examples, data centers and cell towers. Now, we don't see data center REITs as this 2 birds, 1 stone opportunity. We think they happen to provide all the risk of tech stocks with the boring rewards of a REIT. So we wouldn't invest in data center REITs, and cell tower REITs aren't on our radar. We're happy with the 3 REITs we're already holding. So let's carry on and look at the other 3 stocks that are in common between these 2 ETFs. You have Super Microcomputer. We did a piece on them, highlighted it here. It's not a company we would invest in for reasons given in that piece. You have Unity Group. Now they're rather small, $1.4 billion market cap. They have fiber roots. You have SBA Communications. You have a lot of customer concentration risk with the larger telecoms, not something that we'd be interested in. Again, going back to the idea of investing in REITs to get exposure to AI data centers. Now, when we look at these two ETFs, the first question is, why do they only have 7 stocks in common? And to understand that, we need to look at the underlying indices. So the iShares ETF, that runs off an S&P Data Center, Tower REIT, and Communications Equipment Index. What they've done here, it looks like it's running off of some proprietary industry classifications from S&P. So they're simply taking these codes, classifying all companies. They've already done that, right? And they simply say, all right, for these codes, we're going to include these stocks. Rather rudimentary. And then when you look at the index built by Solactive, which powers the GlobalX ETF, one might argue this is even more rudimentary. So this index uses keywords. So an algorithm goes through all the filings and looks for mentions of particular keywords, and then they classify them into these 3 categories, and that's the list that you get. So today we're going to vet the rest of this list from GlobalX. Why? Because we don't have enough time to vet both ETFs, and GlobalX's ETFs have historically been quite useful, we found. So the 18 remaining names left in this ETF, of those we have 4 that are chip makers. So you go down the list, obviously NVIDIA, we've been longtime investors there. Their explosive growth segment is aptly named data center, so that speaks for itself. You have AMD, they're trying to capture some of that opportunity. Intel's just kicking rocks, their data center segment's on a decline. Then you have Micron. So they're said to be benefiting from data center demand, and they produce commodity memory chips, so the revenues are going to be volatile and cyclical. And when we look at those, rather interesting. This chart here shows how revenues have dropped off in fiscal year 2023. What exactly happened there? Well, that is mainly attributed to some of the problems, the geopolitical issues with China. You can see here that this company hasn't been able to grow the revenues very well over the year. Again, they're producing a commodity, so this would be somewhat expected. But you need to be careful about looking at their revenue growth by business unit, because they're simply comparing these quarters to very lackluster quarters in the past. So if you want to invest in Micron based on the growth of AI data centers, you want to look for the segment that's driving that performance, and it happens to be what they describe as compute and networking, or CNBU. And under that segment, they have, 5 other subsegments. The 2 you want to watch, cloud server and networking. So go into their 10K. They talk about these, describe what's going on every year. Products to pay attention to, DDR4, DDR5, and this HBM3E product. So if you're invested in Micron, you want to pay attention to everything else they're up to and how that corresponds to the growth that they see from AI data center revenues. In other words, take into account the bigger picture. We now have 14 names remaining after we remove those chip makers. We have some Indo-Telecom stuff that's not interesting. I mean, it is in its own right, but not for what we're discussing today. We have Australia's Next DC, developing and operating data centers in Australia, so the Aussies will probably key in on that. $7 billion market cap. You see here that they're raising $860 million amid record data center demand. Who would have thought? Then you have China Tower, a state-owned telecom into towers and maintenance. Not interested in that. One can only imagine what's going on behind the scenes there. We're then left with 10 names. So we listed these out. The 3 on the bottom, they're grayed out, too small to be considered. Among these others, at the top, Train Technologies. Very interesting. They do what they call climate products, climate solutions. You'd want to dig into that and see what percentage of their climate solutions are coming from data center revenues. I would imagine not a majority. And you have Microchip there. They have a lot of broad industry use cases. Another data center REIT we wouldn't be interested in. We have Silicon Motion doing flash controllers for solid state drives. We'd invest in Pure Storage instead. We always look for leaders. In the case of Digital Bridge, a very small company managing infrastructure assets, too small. So we would look for a larger manager of infrastructure assets. And you have GDS Holdings. They predominantly operate in China, too much China risk there. And then this IHS, they operate towers in emerging markets, not something that directly relates to AI data centers. Now, one name that seems to be missing from both these ETFs is Dell. You probably would have heard about this on the news and such. Here we've plotted out Dell's quarterly revenues, and the first thing to note here is that, they're talking all about how AI is going to drive all this demand. It should have already been driving demand. And if it was, and that's not reflected on the top line, then maybe it's just not pure play enough, and maybe that AI strength is being offset by other weak areas of the business. So our opinion is that for any AI data center place, you should already be seeing signs of growth. For example, Vertiv, this was a pure play data center company raised by Probos on our Discord server. So they have, you can see some cyclicality in their revenues. I've highlighted that in the yellow bars there. But generally speaking, you see revenues increasing over time at a steady clip. The proposition in their deck is packaged very well. Unfortunately, this is an ex-SPAC, so we would really want to dig into it with a fine-tooth comb before considering any sort of investment. And you see here, this page, I think, encapsulates all the components that one would sell to data centers, and they've been selling lots of them. But when you look at their valuation, this is rather interesting. So we use what's called simple valuation ratio, market cap divided by annualized revenues. You can see that plotted over time on the right. So right now it sits at around 5. Our catalog average is 6. So based on this metric, we wouldn't say that Vertiv was overvalued. But look there on the left. So this stock price has jumped 493% over the past year compared to NASDAQ at 31%. That says AI hype. And it's highly unlikely the intrinsic value of this company jumped 5-fold in a single year. So it's likely this is being hyped, and we might look at that in a future piece. So make sure to subscribe to this channel. Now, when we look at what McKinsey says about AI data centers, they highlight 4 areas that are sort of flying under the radar, things that you might want to think about that not everybody is, all right, in this report. So the first is cooling and energy consumption. So that's rather interesting that accounts, as I said, 40% of a data center's energy consumption. Second is sustainable or green energy. So the largest green energy company in the world, for example, might be something to look at there. Then you have constructing prefab and modular data centers. They talk about some well-established players serving a broad range of industries, while others work specifically with data center operators. Then edge computing. So you see this mentioned throughout the investing decks of the companies we've talked about today, and they talk about big edge providers such as hyperscalers, so Amazon, Microsoft, Google, telcos, systems integrators are acquiring or investing in startups in this space. So things to think about. Just some parting thoughts on AI data centers. If you're a provider of infrastructure for data centers, you should have already been seeing strong revenue growth. This stuff is being built out, not necessarily price growth in the stock price, which would reflect potentially an opportunity, right? You see somebody benefiting from the growth of AI data centers, but they haven't had the hype yet. McKinsey has highlighted these 4 not so obvious areas that investors could benefit from. I mean, what other incidental plays do you think there might be? So put those in the comments section if you would. And ideally, when you think about investing in any company relating to hardware, you want them to also be capturing recurring revenues, not just hardware, because guess what? This boom isn't going to last forever. Now, speaking of booms, I wanted to leave you with this video we did on AMD versus NVIDIA, so 2 companies battling for AI chip dominance, one clearly ahead. Please make sure to subscribe to our channel and support our work. Thanks so much for taking the time to watch this today.